As of 10:33 a.m. Eastern Time on this Monday, November 3rd, 2025, Palantir Technologies, ticker PLTR, is trading at $202.48. That's a gain of about 1%, or just over $2 per share. The stock is having a volatile morning session right before its crucial third-quarter earnings report, which is due out after the market closes today. It opened much higher at $205.04, even tagging a new 52-week high of $206 right out of the gate, but it has since faded from that peak, with intraday trading taking it as low as $202.47. Volume is already heavy at nearly 15 million shares, as traders and institutions position themselves for what could be one of the most significant reports of the season. The expectation in the market is palpable. This stock is up 163% year to date, fueled by a powerful narrative around artificial intelligence. But the immediate, fascinating reality isn't just the stock price. It's the extreme tension visible in the derivatives market. The options market is pricing in an explosive move of nearly 10% in either direction by the end of the week. Yet while the volume on call options suggests massive retail and speculative bullishness, the institutional block trades are telling a much more cautious story. We are seeing data indicating at least one massive bearish hedge placed on October 31st, a sale of 18,900 call contracts at the $160 strike, a bet worth over $81 million that this stock will not hold its highs post-earnings. This is the central conflict for Palantir right now, a retail expectation of unending AI-driven upside versus a quiet professional reality that is bracing for a violent correction. Let's establish the common ground because the bull case is incredibly compelling, and it's the reason the stock has outperformed giants like Apple stock and even kept pace with Nvidia stock in recent rallies. The general belief is that Palantir, after years of being a black box government contractor, has finally cracked the commercial code with its new artificial intelligence platform, or AIP. The company's Q2 report back in August was, by all accounts, a blowout. CEO Karp called it a phenomenal quarter. They crossed $1 billion in quarterly revenue for the first time, and the key metric everyone seized on was the 93% year-over-year growth in U.S. commercial revenue. This single data point confirmed the narrative. AIP is working, and enterprises are signing up at an explosive rate. The expectation for today's Q3 report is therefore high sky. Consensus is looking for revenue around $1.09 billion, representing 50% year-over-year growth, and earnings per share of 17 cents, a 70% jump. The market is pricing this stock as if those numbers are not just achievable, but conservative. But here is where we must challenge that assumption. The deeper take, the one that forces you to reevaluate your position, is that Palantir is priced beyond perfection. Its trailing price-to-earnings ratio is not 50 or 100 or even 300. As of this morning, it is sitting at a staggering 672. That is an astronomical valuation that demands flawless execution and, more importantly, accelerating growth for years to come. This valuation makes Tesla stock at its peak look reasonable. The slightest disappointment, not even a miss, but merely a result that is in line with expectations or guidance that isn't raised significantly, could be catastrophic for the share price. The tension isn't just about whether they beat on revenue, it's about whether the U.S. commercial growth number can possibly match or exceed last quarter's 93% surge. Can they keep up that pace? And is the market ignoring the other side of the business, the government segment, which grew at a slower 53%? That government wing is still the bedrock of the company, and it is famously lumpy, reliant on large, sporadic contract awards. Let's look at the recent stock movement because it tells this story of conflicting forces perfectly. The stock has been on a tear, but it hasn't been a smooth ride. In early October, the stock price took two significant hits, dropping over 7% on October 3rd and another 5% on October 10th. This was in response to a leaked U.S. Army memo that labeled a battlefield communications system co-developed by Palantir as having very high-risk security vulnerabilities. In a normal market, for a company whose reputation is built on secure, impenetrable software for government, this would be a devastating blow. Yet the stock completely shook it off and rallied to new highs. This shows an incredibly bullish sentiment where the market is willfully ignoring bad news in favor of the AI narrative. This is what you see when online investing platforms like the Robinhood app or SoFi Invest are flooded with buyers who are focused on the story, not the granular risks. They are buying Robinhood fractional shares and building positions, creating a powerful wave of demand. This rally was further amplified on October 28th when Palantir announced an expanded partnership with NVIDIA, solidifying its place in the AI ecosystem. Analyst upgrades followed, with BofA Securities raising its target to $215, well above the current price. So what does Palantir actually do to command this valuation? It's not just a consulting firm. It provides two core software platforms. The first is Gotham, the legendary tool used by defense and intelligence agencies for data fusion and operations. This is their legacy. The second is Foundry, which was built to do the same thing for large commercial clients. Think complex supply chains, manufacturing, or pharmaceutical research. The new layer and the entire reason for the 2025 rally is AIP. AIP is the interface that allows companies to plug in large language models like ChatGPT safely into their own private, sensitive data, which is managed by Foundry. Palantir is running AIP boot camps and claims it can get clients up and running on AI in days, not years. This speed to market is its key advantage. The bull case rests entirely on AIP driving Foundry adoption at a rate the world has never seen. The bear case, however, points to the company's long-standing issue, massive stock-based compensation, or SBC. For years, Palantir was unprofitable on a GAAP basis because it was paying its employees so heavily in stock. While it has recently achieved GAAP profitability, bears argue this is still a major drag on real earnings and dilutes shareholders relentlessly. This all hinges on the commercial growth. Comment below with your own estimate. What percentage will Palantir's U.S. commercial growth be in this Q3 report? As we head into the earnings release tonight, the setup is incredibly stark. This is not a stock you buy and forget about in a Schwab Intelligent Portfolios or a SoFi Robo-Advisor account. This is a high-stakes, active trade. People using sophisticated platforms from Fidelity or Interactive Brokers are watching the options chains and the Level 2 data intently. The Fidelity mobile app and the Interactive Brokers trading platform are no doubt seeing massive order flow on both sides. The expectation is a 50% revenue beat. The reality is that the company must clear this high bar and raise its full-year guidance to justify a 670 PE ratio. Let's frame the future outlook using this expectation versus reality model. The bullish scenario is clear. Palantir reports, say, $1.1 billion in revenue, U.S. commercial growth comes in at 95% or higher, and Alex Karp raises the full-year 2025 revenue guidance for the third time. In this scenario, the shorts are squeezed, that massive $160 call selling position is blown out, and the stock gaps up toward $225. This would confirm that the AI adoption is not just real, but accelerating, and that Palantir is emerging as a primary beneficiary alongside the chip makers. This is what the retail trader on Robinhood is betting on. This is the self-investing dream. The bearish scenario is far more nuanced and dangerous. Palantir reports $1.09 billion in revenue and EPS of 17 cents. U.S. commercial growth comes in at, say, 80%. This is by any normal standard a fantastic quarter, but for a stock with this valuation, fantastic is not good enough. A slowdown from 93% to 80% growth, even if it's on a larger base, will be interpreted as deceleration. Furthermore, management warned last quarter that expenses would rise in Q3 due to hiring. If this compresses margins even slightly, the gap profitability narrative is threatened. In this scenario, the stock could easily collapse that 10% the options market is pricing in, falling back toward the $180. The institutional players who bought protection would be proven right, and the retail investment crowd would be left holding the bag. This is the risk of chasing narrative stocks, and it's why finding good investment help from professionals who look at fundamentals, not just headlines, is so important. The core of the issue is this: the market has priced Palantir as if its victory in the commercial AI space is already guaranteed. The company's platforms are being compared to the next operating system for the enterprise. But the reality is that this is an incredibly competitive